Recorder is going. Now, we're going to look at Google. First thing I want to make clear to everybody. Okay? First thing. There are two classes of the stock. Both which trade a lot of options. Okay? There is Goog and there is Google with the L on the end. Okay? As you'll see, Goog with the L at the end, like what we have up here, Alphabet Inc., is trading about 11.35. Goog, which is the old Google, trades about $10 less. Okay? I want to make it clear to everybody that if we have a signal, if we put something out, it will be in Alphabet, in Goog with the L, Google. Okay? Because I know in the past there has been some confusion. So we are evaluating Alphabet. All right. Let's get a whiteboard going here. Stock is 11.35. What is our expected move? Anybody? Okay, 51, 52. Yeah, it's right around 51 bucks. Okay, now remember, this $51 is to the end of the week, right? We're measuring to the end of the week, February 8th expiration. If you look on Thinkorswim, they're right in agreement with us for the end of the week. But the one-day market maker move, so the market maker move based on the earnings report, okay, is about $44 to $45. Okay, we'll see if that comes into play at all in our evaluation. But I just want to point that out for those of you looking at Thinkorswim that are looking at that one-day move. That is what this is. Okay, that is the difference here. All right, so Arnab, I'm not sure how Thinkorswim calculates that, to be quite honest with you. Okay, so the expected range is 1084 up to 1186. 1084, 1186. What do we have in those range is? Okay, well, you've got the 50-day moving average right down at 1070. On the upside, there's really not a lot of resistance above the 200-day moving average, which is about 1130. Okay, so again, you've got the 50-day moving average which is 1065, just below what the expected move is. And the 200-day moving average, we're just above it right now. So there's not a lot of resistance at all. 50-day moving average, 1065, and no resistance really above at all. Okay. So, what does that tell you, if anything? What does that tell you from a technical standpoint? What it tells me is, listen, there's a 50-50 chance it's going either way. But based on technicals, if this thing does move higher, good guidance, good numbers, whatever it is, okay, it certainly seems like there's a lot more room for it to run to the upside. Now, I'm not saying that we're bullish, bearish, or anything right now. But Trevor, you just hit the nail on the head. Okay, so that's what I'm looking at before we go into this. So let's check out first an iron condor right around our expected move points. Okay, those expected move points again being, excuse me, 1084, 1186. This is really weird. I'm not seeing, I don't know if you guys are seeing the same, and I just don't have it on here. I'm looking on Thinkorswim right now. I don't see the 1180 strike. Sure enough, there is no 1180 strike. How weird. Okay. So this doesn't look very good. This is the 1090, 1080, and 1182 half, 1192 half. Iron Condor trading for about, probably trading for about $4.30. Break evens there would be 1086.70 up to 1186.80. Okay, in terms of how that looks with the expected range, that's not bad, right? That's like almost right there, both on the up and down side. But the fact that it's only $4.30, I don't like it. To trade that, I would want to be closer to 475 or 480. For sure closer to 5, Rob, but I would do it at 475 or 480. Okay, Joe, I'm answering you right now. All right. So what if we adjust the strikes just a little bit? Okay, what if we did this one instead? Okay, what if we adjusted the strikes to the, still the same on the downside, but adjusted the strikes on the upside just down a little bit? But if we could get, let's say, 475 for that, now break even still going to be, it's actually going to be a little bit better on the downside now. And you know what? I missed this. My math was off. This should actually be 1085.70 here on the downside on the last one, which makes that actually a little bit more palatable. But anyway, here we've got 1085.25 up to 1182.25. Okay, it's not bad. It's definitely not bad. A little tight to the upside, but now we're, closer in the range of what we'd want to get. So let's just suffice it to say, that the iron condors may not be what we want to do. I don't like looking at strangle swaps on a $1,500 stock or $1,000 stock because the vega of each individual option is too high. And if we're wrong in our assumptions, even by just a tad, it can really, really throw the whole evaluation off. Okay, so, but based on what we've seen here, okay, based on what we kind of evaluated and that potential on an upside move from a technical standpoint, I'm not saying that that's going to happen, but if the upside move happens, I probably want to look at an upside type of trade, whether it is an upside calendar, whether it is a broken wing butterfly, something, some kind of upside that from a reward to risk standpoint makes sense. So let's first look at an upside call calendar. Okay, so with that expected range being around 1185, let's go right to the 1185. So let's look at this week. And let's go out to next week. Which again, just like I mentioned before, on a strangle swap, I really don't love a call calendar or any kind of calendar in this type of stock where we have such huge vega, unless we know that we are just pricing this thing so incredibly in our favor. So you can see I'm taking next week's volatility down to a 22. I don't think it gets that low. In fact, that's probably way too aggressive. Let's see what this looks like at a 23. Okay, but if for whatever reason this modeled out to look good, then that's something I would consider. My guess is this is not going to model out very well. Okay, so something like this is going to cost, it may not be too bad. Probably about $2.50. Now, If we held this for a couple days, we could see from the P&L here, remember, we looked for about a 1-to-1 reward to risk, right, on a calendar. This is better than that in the sweet spot. This is better than that. What I don't like about this, though, is if there is some sort of explosive blowout move to the upside, we could be right on direction, meaning that we have an upside call calendar, but if there's too big of a move, it could actually go against us. So what I would look to do then, knowing that maybe these vols actually do line up, let's pick a different strike. Rather than the 1185, let's extend that up a little bit. We don't need the stock to go all the way up to the strike we select. We don't need it to go beyond the expected range. We're just evaluating this from a reward to risk. And here we go. There's no 1200 strike either this week. So weird. So let's go to 1205. That is really, really weird. Let's go all the way to the 1205 here. Okay. This is not going to model real good based on where I have the vols, but this thing's going to cost probably around $2.20. And going out 2 days, it's not so bad, actually. And you can see what this did on that break even on a big blowout move to the upside, guys. It actually puts our break even all the way up well over 1250, where before it was about 1210. Michael, there's no 1200s for this week. You may have it for next week, Feb 15th, but there are no 1200s for this week. Roger, we could do that and turn it into a skewed. Yeah, we're not looking at Feb 15th, though, Michael. We're looking at Feb 8th. Turn it into a skewed spread like what we have in PayPal, like what we have in Microsoft. That's going to be too expensive here. I don't want to do that in Google. So I don't love the calendars here. Let's look at like a broken wing fly type of trade, or just a straight call spread, or a straight butterfly. But what I would look at is probably a broken wing fly for this week. 1186 is the target. Let's look at something like maybe 1170, 1190, 1195. So that's right in the range of about $5. Reward to risk is really good. We can even tighten that up if we want to get a little bit less expensive. Maybe we go 1170, 1185, 1190. That's probably even better reward to risk. Let's see if we tighten the short side of the spread up here a little bit. I like this, guys. I really do. For an upside play, if we could get in this thing for 3 to 3 1/4, and listen, the stock is up even another $5 or so since we've started talking. So we don't have to chase it now. We don't have to get in right at this price where it's trading now. We can hopefully wait for a little bit of a pullback and put a bid out there. So if this thing comes down, we can get in it. I really like this. I'm going to put this out there, guys. I'm going to put a $3 bid out for this. Now, There's no way you're going to get filled at $3 right now. But if the stock does come down back into the 11, let's call it 32-ish area, 1134, could be a very good possibility of getting filled there. Okay, and what I'll do, everybody, is after I put the signal out, after I get the video up on the board, I will do one of the P&L Excel spreadsheets on this for everybody. Okay? All right. Any questions here? All right. I'll be right back.